am the chief strategist and portfolio manager and a partner at Logica Capital Advisors. Logica, at its core, is a firm that trades what falls into a classification of long volatility product, although we actually, our flagship product is what's called an absolute return product, so the Logica absolute return product. And it's very unique within that niche, because most absolute return products are running significant short positions, which expose them to high negative skew. The products that we choose to trade put us into a very positive skew framework, right? So in some weird ways, we overlap with the more traditional crisis risk type products, but we're trying to deliver a positive return under all market conditions as compared to simply under crisis dynamics, although that tends to be where we shine as all of our products start working together at that point, all the securities that we trade. What most people know me for at this point is the observations that I've made into the dynamics of passive investing in the markets. I wish I could lay claim that that was 100% de novo and that I came up with it, but I'll be totally frank with you that the vast majority of my insights are actually just taking insights by other people and trying to push them a little bit further, right? So I would actually highlight the work actually at AQR, which is funny because I tend to get into tiffs with Cliff Asness on a fair basis. Lasse Peterson at AQR wrote a brilliant paper a couple of years ago called Sharpening the Arithmetic on Active Management, which challenged the work of Bill Sharp in 1991. It says, something we've all kind of come to accept, which I think is wrong. The idea that it's a zero-sum game and that active managers are effectively trading against each other, and therefore passive managers, by taking the best information that is available from the outcome of that battle between them, right, what we call the current price, are able to free ride on the system and outperform the average manager because they're able to offer lower fees, do it at lower costs, right? The assumptions that Bill Sharp made in that paper simply don't hold water. Right. The most obvious one being that passive investors never transact, right? Which means raises the obvious question, how do you get into the market? Well, it has to be magic, right? How do you get out of the market? That has to be magic too, right? Well, Brent Johnson at Santiago Capital has a great line, you either believe in magic or you believe in math, right? And I believe in math, and I don't think there is any magic, and would go a step further from Lasse's work and point out, Lasse's work was focused on the idea that on index rebalancing, passive investors would have to transact, and therefore they became active for that period in time. My insight and observation was just very straightforward, which is, well, wait a second, they're transacting every single day because they're receiving flows. And if they're receiving flows, then we can actually begin to model and understand the impact that they have on the market. And when you do that, you discover some really surprising things, which, as you talked about, I've shared broadly and influence the way that we think about the world at Logica.